Thus far, thanks for joining. I'm Alex Beret. I'm the YPN chairperson. I want to thank Rick Fields for joining us today. I'll give a brief intro in terms of what YPN is, and certainly suggest folks check out the GLAR YPN website. I think the goal there is we are making some considerations and shifting from young to maybe all. There's a lot of folks in our business and that are very experienced and have a lot to share, and we want to take advantage of that moving forward. So similar to events like today, 2020 was certainly an interesting year, and if anyone else took advantage of last year's tax extension, it feels like tax season again has shown up a lot quicker than usual, and certainly with PPP loans and a bunch of different availability from programming. There's some things to certainly take into consideration for prep this year. Rick Fields is a senior partner of Associates in Accounting and CPA. He's been with us before for this event and has always provided some excellent information to help folks in terms of upcoming prep, things that we're not thinking about, deductions. I'll provide a little context on Rick and partner Brett, and then we'll let him get started. Rick is a graduate of Bellarmine University, go Knights, a CPA for 40 years, college professor for 30 years. His primary professional responsibilities include tax planning to reduce income taxes of businesses and their individual owners, something I think we're all interested in there, Rick. He's married, has 4 kids, 8 grandkids. Associates in Accounting is a local accounting firm representing clients in 32 states. Their primary focus area are small businesses and self-employed individuals. They have a significant concentration of clients in real estate, investor, construction, and realtor broker industries. Applicable here, Rick, we appreciate that. And their team consists of 17 professionals spread over 3 states and 2 countries. Brett Johnson, I don't know, Rick, if Brett's gonna certainly chime in, but Brett is with Rick, also CPA, alumni of University of Kentucky, MBA grad of Liberty University in Virginia, and obtained his CPA license 2 years ago. Prior to his current role, he worked at a regional CPA firm for several years out of school, then transitioned out of public accounting and worked in private accounting in the banking and technology industries. Started with Associates in Accounting in 2019 with a primary focus in business development. He's married to his wife, Logan, with no kids quite yet. Enjoys meeting business owners and helping them accomplish their financial goals. So appreciate both Rick and Brett being here. Clearly from those bios, there's a lot that they can certainly, they know and are in our business on a daily basis. So I'll turn it over to you guys. And again, thanks for coming. And this event is also being recorded. So if anyone needs to circle back, we'll have that available.
Alex, that's a great introduction. I might need to hire you as a publicist. Thank you so much.
Well, if we don't get any more inventory on the market, then you might get my call sooner than later.
There you go. There you go. Yeah, it's lots of buyers and not quite enough sellers these days. I understand all too well. The introduction was excellent. A little bit more about us. We are located in J-Town, and in particular, we have a firm that is a fairly strong mix between accountants, but we also have bookkeepers. We have paraprofessionals that do a lot of work for us. We have accountants, certified accountants. Those folks that are in other countries as part of our team are actually certified accountants as well. So we get a great deal of cultural diversity here. It's a lot of fun actually to come into work every day. But along that line, one of the emphasis that we have with all of our small business and individual clients is we want to educate them. And we do that individually, one-on-one, as we work with clients. We also love to do it in settings like this. And I'm very appreciative that all of you were willing to commit your time to this today. Not done this with you guys by Zoom. We're usually in person, but the fun thing about Zoom is I see all of your names. So usually I'm looking at placards on desks that are spread out over a fairly large room. So kind of fun to see who all of you are, and I see some familiar names on there and welcome friends of the practice as well. So thank you very much for the time. We have some years I start this presentation basically saying, there's not been a whole lot that has changed, but we want to go back and review some things. This is not one of those years. There has been a lot of change. You think about 2020 in general and just what it has done to all of us on an individual and business basis. And then you think about that 2021 is here, and I'm not sure that the turbulence level is substantially different at this particular moment. So that being said, I've got a PowerPoint deck that I want to go through today that will kind of keep us on task. Two things that are very important about these presentations: whenever we present to a group, you get future question rights, and what I mean by that is you're going to think of some questions while we're together today, and that will be one of the most important things that we talk about, because I can drone on and on about a lot of technical information and maybe hit you where you are and maybe not. But your questions will cause us to talk about things that are important to you. So please let me encourage you, send questions throughout. We will address all of them to the extent that you guys have time to allow us to do that. The second thing is, with regard to future rights, we welcome inquiries from you guys after these presentations as well. So you get home later, or it's next week or next month, and you're thinking, there's a question, man, I wish I could ask those guys that did the presentation. Then your questions will be welcome at that point as well. So you will have email access and demographic information provided to you. We will also send out specifically a follow-up package, because we'll have your emails. So we'll send out a follow-up package that simply says, here's who we are, here's how you can reach us. And those are, we would love to have all of you guys as our clients, but regardless of whether you're our clients or not, we are more than glad to answer your questions and discuss any of your specifics that you'd like to talk about. So please take advantage of that. We really, truly, what gets me up in the morning is being able to do the strategic work with individuals and small businesses. And realtors, you are a small business. And it's just the nature of how you get paid, how things are structured, and all of these trends and so forth that you're hearing about are very much about that. So with that in mind, I'm going to share my screen. So let me get straight to the agenda, because I think that will be helpful to everybody. Hey, there we go. Already gone through an introduction. We want to talk about legislative changes today because they are relevant to you guys. And there's just been a lot of things that have happened from the standpoint of things that affect small businesses, things that affect taxes, things that affect incentive programs, things that have caused you to get checks in your mailbox, just a lot of things under that topic. Planning steps are kind of interesting, because once we look at all of that legislative change, then the planning steps are also somewhat different. And so we're going to spend a little time talking about that. Then I'm going to shine up the crystal ball before we get out of here today and give you some future predictions on what's coming next. And then we'll summarize and have some times for question and answers. My goal will be to wrap this up by noon. Again, there's a lot of data there, so I'll do my best to be efficient. But again, your questions need to be addressed. And so make sure you get those questions to us, and we'll kind of go from there. So with that as a jumping off point, let's get going. Wow, what a year, right? When you look back at last year, and it was this time last year, as a matter of fact, I think we just gotten back as a family from a Disney trip. And it was kind of like, yeah, that's a cool thing to do before we get busy at work. And then March came and life changed for all of us, right? And you see the things over here on the right that have been, well, let's be fair, maybe a little unusual this year. COVID, nobody anticipated that was coming. We were hearing some buzz this time of year about there's this thing going on in China, right? But at that point, it didn't mean a whole lot to us. Presidential election was starting to heat up, and it looked kind of a normal event at that point. Has been anything but that over the last 12 months. CARES Act passage. Well, COVID happened and Congress did what Congress does. They felt like that they needed to bail us out, and they created a very extensive legislation package that addressed coronavirus and the various facets that they felt like needed to be most addressed. And we got the CARES Act in late March and early April. And again, there are things that were very relevant in that package that we need to talk about for a few minutes. Some of those things are detailed in the next two items. We've got stimulus checks. Hopefully most of you did get stimulus checks and got to participate in that. And then we also have PPP loans that came out of that. That's called a payroll protection program loan. And I want to talk in some detail about that, because even though you guys by and large are going to be self-employed individuals, what you're going to find out is that you were considered payroll individuals for purposes of that program. And then last but not least, because Congress needed something else to do, I think, we ended up with a COVID relief bill right before Christmas. And that also will have effects on you last year, but it will also have effects on you for today and going forward. So with all of that being said, as you might imagine, there are a lot of years that a slide like this can't be created. It simply didn't end up being a particularly normal year by anybody's measurements. And we've heard the term new normal many, many times over the last 10 months. So what about COVID? Well, the economic disruption was kind of interesting, wasn't it? You know, we were told in March we needed to go home for a couple of weeks so that this thing would be over and we could go back to our lives in normal. And then we were told 2 weeks needed to be 6 weeks, and a lot of businesses were shut down. We represent about 300 small businesses. Those small businesses employ people. I think we've looked at these numbers before, but our firm probably represents businesses that employ a couple thousand people total. They are small businesses, so most of them don't have a great number of individual employees. What we saw very quickly was a couple of things. When these businesses were shut down, most of them were not particularly well prepared to be shut down. You know, you guys as realtors, if I were to take a poll around the room and ask you how many of you were ready to just simply not work and not have income for 6 to 8 weeks, most of you guys, probably I'd get a fairly lukewarm response to that based on other realtors that I've dealt with over the last 12 months while we've been helping people with COVID and so forth. I mean, I hope you had some personal savings. It's not a lot of fun to have to use it in a time like that. What we saw from most of our realtors, and we represent some fairly sizable brokerages as well, is that most of them had so much activity in the pipeline when COVID came and we were being told to shut down last March 13th here in Kentucky, that they continued to have income that came for the next few weeks, because you guys don't sell products and instantly have a check in your hand, right? There's a process, obviously, of getting loans, of closing, and typically that's, even in today's really breakneck pace, that's typically as much as a 30 or 45-day cycle. So a lot of folks had a lot of income still coming in after that period of time. The real bubble was felt more in the summer. And it was also felt by what shows up in the other two items on this slide. People began to get sick. And because of the sickness, there was a great deal of fear that developed. So people who might have made moves didn't make moves for a while. And when folks are not willing to move and not willing to sell their property, that obviously has economic disruption for you guys. And I know all of you felt it to a different degree. It's really amazing in dealing with the diverse population of businesses that we deal with, the responses that we got. We don't have a great number of folks in hospitality and restaurants. So we didn't see folks that were just tremendously damaged by and large, but everybody had some effects of this. It was difficult to show a house. It was difficult to get a closing schedule. People weren't in their offices, everything that just went along with that. So obviously you felt it. And again, I know I don't need to dwell on it more than that. The presidential election, wow. I'll try really hard today to not make a lot of political statements. That's not my intention. But we have to realize how much this has impacted and is going to impact you going forward. We really truly had an abnormal election process due to disruption. Was there widespread fraud? That'll be debated forever. No one's ever going to readily get to the answer of that. But certainly the process itself was abnormal. My guess is a number of you guys may have voted absentee. You may have voted before Election Day. Those are things that we were never able to do in the past. And we were encouraged to do it this year because, again, the 2 weeks, 6 weeks, 6 month, now year plus process of getting through this pandemic absolutely disrupted the election process. It was really interesting. We have a large center here in Jeffersontown that collected a lot of votes this year. based on the way the polling and the vote access was set up. And there were days that the parking lot was so full you simply couldn't get into it. And we're talking about a Monday or Tuesday during business hours. Very abnormal process. The effects of that on the legislative process were crazy. You know, we had, what did our legislature, both in the state when it was in session and the federal level, deal with all year long? They dealt with two things. They dealt with COVID and they dealt with the presidential election. And there were lots and lots of discussions and arguments and polarization. Don't think any of us in our lifetimes have ever seen a country quite as polarized as ours is today. And this obviously has a great deal of effect ultimately, maybe not today, maybe not tomorrow, but ultimately on the economy and on what you guys do and the tax laws that are going to be passed. So then we get to number 3. The past laws all focused on COVID relief, right? Self-employed people like you guys could actually go and get unemployment. That's never been done before. In addition to that, you also could get PPP loan money, and that money was going to be forgivable where you didn't have to pay it back. So even though it was called a loan, under 90% plus circumstances, not going to have to repay. Those were the things that were focused on. But subtly behind that, there were a number of laws that were passed that had a devastating effect on the infrastructure of the economy as we know it. And of course, we saw all of that through the marketplace. We saw all of that through unemployment. And while we've had recovery, we've had pockets of recovery. We've not had full recovery. And there are a lot of folks that are without jobs today that had jobs a year ago. So the past laws have really changed tremendously. The laws that were passed have really changed tremendously the turf on which we walk today. For employers like me, when we went to try to find a candidate for a position, one of the reasons why we have employees in 2 countries outside the US is because there are candidates available there. A year ago, to go find a staff accountant with 5 years experience, I would have been lucky if I've gotten 1 resume, maybe 2. Very different hiring environment today. There are a lot of people who are out there that are job hunting that weren't a year ago. So things have changed, and the past laws have had an effect of that. The politics in play have been interesting as well. And again, I want you to understand this because it affects the things we're going to talk about for the next 30 minutes or so. When the politics became in play, what did everybody want to do? They wanted to be seen, as politicians frequently do, as being the solutions providers, right? So whether it was the CARES Act is a reflection of what I think we ought to be doing to get the country propped up and to get economic help into the hands of individuals and businesses, or whether it was a matter of holding off particular types of aid that was being proposed during the latter part of the year because they didn't believe it was addressing the right people. There was a partisan divide that probably is as strong or stronger than any that's been seen in this country in 250 years of existence. So when you look at it from that standpoint, it's very difficult to sort out what is in the benefit of the politician and what's in the benefit of the country from time to time. And again, this isn't a Republican, Democrat, conservative, or liberal type of statement. It's just the reality of the turf we live in. And I know that you're seeing it as well. And then that brings me to the last item. Tell me where you're getting your truth these days. Are you getting it from the news? Are you getting it from your elected officials? How is it that you know specifically whether or not you should be wearing a mask, shouldn't be wearing a mask? We've been told both by the federal government. Whether or not the vaccine will be totally effective or partially effective. We've been told both by the government. I could go on for a while, and I'm not trying to create a bully pulpit today. I'm trying to make sure that you understand the context that we're going to be looking at specifics from this point forward. So with all of that as a background, I want to jump into some of these relief programs and make sure that you're aware of them, and also talk about the historic programs that have already been put in place in prior legislation as well, because those are the foundation for what has happened in the current legislation that's just been passed at the end of the year. So far, so good. and I'll breathe occasionally just to give you guys a chance to catch up. I just know I have a lot of material and I want to be respectful of your time and make sure we have plenty of time for questions and answers. So let's move on. PPP business loans. There are 2 loan programs out there that have been available to try to help businesses. And keep in mind, this is relevant to you guys because all of you that are self-employed realtors are businesses. If you're a broker, you're a business. If you are an investor, you've got a business. If you are a flipper or a builder or any of these other real estate affiliated groups, you have a business. So the 2 main platforms that were put out in the CARES Act were the EIDL loans, which have always existed. That program stands for Economic Interruption Disaster Loans. And the EIDL loans are the types of loans that have always been made by the SBA. Whenever a storm comes through, whenever there's a flood, whenever there's a tornado, when your business gets knocked down and can't operate, the SBA has always made low interest rate loans. And that program was basically extended to every business because the thought was that there has been economic interruption. And so the EIDL loans existed and many people applied for those. That program had money in it up through about August, and dollars were given that are going to be paid back over a very long period of time at 4% interest and no payments required for about a year. That program always existed. The PPP business loans program did not exist prior to CARES. And basically the whole thought process was, let's give businesses money to be able to keep their employees paid. So if we can keep their employees paid, the employees will spend money and prop up the economy. And the concept was right. The execution was a little rough. It didn't work out quite as cleanly as what Congress had intended early on. But the principles of this were, what about the self-employed people? What about the realtors of the world? Congress said, we're going to let this apply to businesses that have employees, and we're also going to let this apply to self-employed individuals as well. So in rough numbers, you were allowed to get 2.5 months of wages, or if you were self-employed, 2.5 months of profits after expenses loaned to you. And as I say, self-employeds were qualified. If you use the money during the 8 to 24 weeks, and that changed partway through the program, it went from 8 weeks originally to 24 weeks by the time the program was amended and adapted fully. If you use the money for that 8-week period, you didn't have to pay it back. And you could use it on wages. You could use it on facilities. There were a laundry list of things you could use it on. If you were self-employed, basically you just had to have the money come into your business and pay that business out to yourself over an 8-week period. As I say, the 8 weeks was stretched to 24 because a lot of businesses indicated that with COVID going on and with the unemployment benefits that were being paid, they couldn't possibly spend the money on employees quickly enough. So it went to 24 weeks, which is 5.5 months, to allow businesses an opportunity to use that money for their employees, and most of them did. As a self-employed individual, what we told all of our self-employeds was, look, you need to write a check from your business to yourself. That shows evidence that you're paying yourself personally, and that qualifies to satisfy the standard that the monies were used and therefore could be forgiven. And at this point in time, the SBA has been taking forgiveness apps for the last couple of months, and they have forgiven a great deal of these. As a matter of fact, we've not had a single, we had probably 150 businesses that got PPP loan money. We've not had a single one that has not had their funds forgiven. So once the standard was changed, it became much easier for people to meet that. The reason this is important, even though it's historical, because what's now being called PPP Round 1 is what I'm talking about. The new bill, which we're going to jump into in a couple of minutes, created a PPP Round 2. So we need to talk about that a little bit, but you need this historic context in order to understand what is the same and what isn't the same in Round 2. So let's talk about the new bill a bit, shall we? Again, what does Congress do? Well, they fix things because they want you to vote for them again, right? That's kind of the way you play the game in politics. And so what they were hearing as the first round of stimulus money ran out quickly, because those stimulus checks early on were not a whole lot of money in the scheme of managing and paying for a family or even individuals. So that money ran out quickly. The money that really ran out of the first bill quickly is that extended advanced unemployment benefits, which here in Kentucky resulted in people getting about $50,000 on an annual basis in unemployment benefits. Those ran out roughly 6 months after the bill was passed, sometime in mid-September for most people. So you got 6 months worth of $1,000 a week type of unemployment benefits here. And that propped up individuals much more so than a $1,200 stimulus check, which was issued very haphazardly back in March, April, and May. That program was poorly administered. As a matter of fact, as an aside, it created a great deal of tax fraud. We have normally in a normal year, we'll have a half dozen people perhaps that will have their identity stolen for tax purposes. That number reached almost 100 people, and almost all of it was through stimulus checks issuance last March, April, and May. So basically the stimulus money helped, but it certainly didn't prop up a whole lot, but the unemployment did. Once it stopped in September, now we have people who are beginning to not be able to pay for groceries, rent, necessities, clothing, sustenance, all the things that were really important to most of us on a daily basis. And that's why the momentum began to build in the fall for an additional relief bill. The problem in a nutshell is very simple. There are a lot of folks in Congress that are a bit more fiscally conservative that feel like that we have spent a lot of money that we don't have and that we've really advanced the federal debt. And so they took a mindset in of limiting what we would do in a relief bill. There were a lot of other folks that says who care. It's our money. We can owe ourselves these monies. We can pay for it in the future. We need to give relief to anybody and everybody that needs it. Here we go again. They basically revisited the same troughs, but with some differences. One of the biggest areas of debate was how big should the stimulus bill be? How big should the stimulus checks be? And as you know, the first time around, it basically was $1,200 for an individual, $2,400 for a couple, $600 for their kids up to, I think, through age 16. Those all came your way. If your income was $100,000 or less as an individual, or $200,000 or less as a married, there was a phase out from $75,000 to $100,000 for individuals, and a phase out from $150,000 to $200,000 as a married couple. So you got the full amounts if your income was below $150,000 as a married couple, or below $75,000 as a single individual. But if you were above $100,000 as a single individual or $200,000 as a married couple, you didn't get any stimulus. Now, the irony is stimulus has a pattern that goes all the way back to 2001. And truly, these stimulus checks and your qualifications for those, the way the law was written, it's based on your 2020 income. And a lot of people don't understand this. But the problem that Congress had is that they don't know what your 2020 income is until you file your 2020 tax returns, right? So in order to do this, they assumed that your 2019 income, or if you hadn't filed your 19 returns, your 2018 income would represent what your 2020 income was likely to be. So to make a very simple example, if you had $210,000 worth of income in 2019 as a married couple, you didn't get a check because the assumption would be that your income in 2020 would be similar. But suppose your income in 2020, hey, it's a COVID year, right? Things changed. Suppose your income was only $140,000. You qualify for the full stimulus. You didn't get a check in the early payouts, but you will get to claim those stimulus payments when you file your 2020 taxes. And you'll get those $1,200 and $600 additional payments paid out to you in addition to whatever refund you normally would have qualified for, or as a reduction of any taxes that you owe on your 2020 return. So again, 2020 will be an opportunity to look at your income and say, oh, okay, now we know what you really had in income, and now we'll pay you the rest of the stimulus check, or maybe the full stimulus check, because we didn't understand that you qualified before. What if it worked the other way? Suppose that you had $140,000 worth of income in 2019, so Congress sent you a check. Then in 2020, you have $210,000 worth of income. Are you required to pay it back? The answer is no. So even though 2020 is the year that was used to determine whether or not you ultimately were due a stimulus check, if you got one earlier based on 2019 income level, you don't have to pay it back just because your income increases in 2020. So this was a win-win. You got to keep it based on the lower of the 2 years. So some of you will be dealing with this upon tax filing for this year, is my point. So kind of keep that in mind. So that I say that to say we did the same thing in the COVID relief bill that was put out in December. We, instead of $1,200, all the checks are $600. $1,200 for a couple, $600 for an individual, $600 for a child. The same income criteria were used in the second bill. Now, you've heard a lot of buzz, probably, especially if you're a political junkie, about a $2,000 stimulus check. And there are lots of folks in Congress that feel like $600 was not enough. And there's a lot of conversation about additional aid coming. And one of the thought processes was that if we get a Democratic Senate, it might be much easier to pass that. And lo and behold, we have a Democratic Senate by the skinniest of margins, but we do have a Democratic Senate. So the thought process is that there will be additional incentive bills being passed shortly, because there were a lot of folks who wanted to spend more, both in the House and the Senate, that did not get their way in this original bill. There's also a round 2 of PPP loans. The difference in the round 2 of PPP loans from round 1 is that it works exactly the same way in virtually every characteristic, every instance, except you have to qualify to file for round 2. The qualifications are pretty simple. If you have a business and you can prove in your business, and I'm talking to a bunch of business owners, you can prove in your business that your gross receipts, your gross income before expenses, was 25% less in any calendar quarter as compared to 2019, then you qualify. So suppose that April, May, and June came along and you guys basically either said, I'm going to go to my basement, I'm not going to go out into public, and I'm not going to sell anything, and I'm not going to have any commissions, and I'll get back to work when this thing is gone. Or for whatever reason, the economic downturn just resulted in your income in April, May, and June being substantially less than April, May, and June last year, then you qualify for round 2. You qualify even if you got money in round 1. You qualify if your round 1 money has not been forgiven yet, because there's still forgiveness applications going on, but you do have to meet that criteria. For some of you who are brand new business owners, if your business was in existence on February 15th of 2020, you may qualify even if you weren't in existence during 2019 and don't have a base to compare to. And there are a bunch of I'll call them complicated rules. They're not that hard, but they basically have to do with you comparing subsequent quarters in 2020 to early quarters in 2020 to see if you've had an economic disruption based on COVID. It's a flawed system, especially when you consider things like real estate, where you guys can make a chunk of income on one sale. Obviously, your all's income does this all the time, right? Goes up and down. And so from that standpoint, it is worth you reviewing your income to understand whether or not you qualify. Because all of you have different circumstances, the odds of you guys being down for one particular quarter are pretty strong, really, just based on normal economic activity fluctuations in your sales, and the fact that 2020 has been a weird and wonderful year. Stimulus checks based on the same thing. The amount is less, as I mentioned, $600 instead of $1,200, and possible additional amounts coming. So these are things I've already covered. Same qualifications as round one, except that business gross receipts have to be less, and typically it's based on calendar quarters as compared to the same quarter during 2019. By the way, if you were open for a partial part of the year during 2019, if you started selling real estate in July, you can compare any quarter in 2020 to the July or October quarters of 2019. And if you are down based on that, you can do the same thing. If you started in October, the same thing. Fourth quarter last year can be compared to any calendar quarter this year. So there's a lot of mathematics, gymnastics that have to be done to determine your qualifications. Now, there were probably in this bill, probably 50 to 60 tax law changes. And I can guarantee you that 90% of those plus you guys will not care about. There were some energy credits that were extended that will affect a few of you. There were some characteristics that were put out there that were, they tweaked some particular tax laws. Again, you guys as realtors, most of these law changes will have no impact on you whatsoever. And for 2020, there's not a whole lot of tax law changes that are going to affect you, but there are three distinctions to that. Up until this bill was passed in December, Congress and the IRS had been saying inadvertently that the PPP loan money that was forgiven in round one was going to be taxed to you. Congress made it 100% clear that neither round one nor round two forgiven dollars are going to be taxable. And guys, that's huge. As a self-employed individual, you could max out on this at around, there was a cap of $100,000. So you could max out on this at roughly 20 grand was the most you could get if you were a sole proprietor with no employees. And that 20 grand up until December 24th was going to be taxable to you on your 2020 tax returns. Now it's very clear in this bill that the loans will be forgiven and you will not have to pay taxes on those dollars. They did it with a backhanded thing. They basically said the expenses you paid out of the loans were not going to be deductible. That's been made clear as well. That expenses are deductible. The proceeds from the PPP loan are not taxable. So this is a win-win situation, and it's going to be huge for some of you and going to be significant for all of you that participated in first round or second round. So kind of keep that in mind. Another thing that is significant, the business meals deduction for the next 2 years, 21 and 22, has been lifted from 50% to 100%. The old rules for a very long time have been if you go to a restaurant and spend $50 on a business meal where you met with somebody else, a broker, a realtor, anybody else, a customer, that you were only able to take a $25 deduction. Half of that money was actually going to come off of your business income before you determine how much you had to pay taxes on. Now that has been lifted. And so for 2021 and 22, you're going to be able to take 100% deductions. So that entire $50 is going to be deductible this year and next year. And then last but not least, and this is not a huge matter, but it is a matter that you need to be aware of. A lot of folks do not itemize deductions these days. As a matter of fact, tax policy groups have indicated that 11 out of 12 taxpayers no longer itemize deductions because the standard deductions are so high now that it's better for you to take the standard deduction built into the law than to actually deduct your taxes, your interest, your charity, your medical bills, the things like that that are deductible from your income. And in round numbers, those standard deductions are about $12,500 for an individual and about $25,000 for a married couple. So unless your actual deductions exceed that, you just take the standard deduction and you don't have to report all of those individual things. Well, charitable contributions to nonprofits this year have been beaten to death for two reasons. First off, the economic malaise that was created by COVID and all the implications with that have just caused people to have less money to contribute. And then secondly, people filed their 2018 taxes during 2019, began to understand that my charity isn't doing me any good anymore. They filed their 2019 taxes and saw that that was the case as well. And the amount of charity that was being contributed strictly for tax deduction reasons basically has dried up and evaporated. So you add in a bad economic situation to the fact that there's no tax advantage for charitable deductions. A lot of nonprofits are seeing their revenues down substantially. So Congress has added rules now that says we're going to allow a single individual to deduct charity, even if they don't itemize, and same for a married couple. For a single individual, it's not a lot of money, but it's $300. You're in a normal type of tax bracket. That could mean anywhere from $50 to $150 to you, depending upon your income levels. For a married couple, it's double that, it's $600. So the point is, be aware that you have a situation where you can take some charity deduction. If you're one of those folks that rushes out there and deals with TurboTax and those types of things, you may think I don't itemize deductions and therefore I don't need to worry about that. But there are some deductions allowed for individuals and couples, even if they take the standard deduction on their tax return. I'm about to bring it home, folks. I know it's a lot of information in a short period of time. I've already talked about this, but I'll show you the slide. The loan forgiveness, non-taxability was made crystal clear in this last bill. You can see the information's here on the slide. Made sure that the expenses are deductible and that the forgiveness proceeds are not taxable. And my last statement's the important one. This is a huge win for small businesses. 20 grand for most of you guys that are straight up self-employed individuals. Your tax rates are going to be anywhere from 12 to 30%, depending on what your income levels are. So, you're suddenly talking about anywhere from $2,400 all the way up to could be as much as $3,000 to $4,000, again, in those upper brackets. So a huge win for small business. Just want you to keep that in mind. Business meals deduction, just mentioned it a minute ago, 50% deductible until 2021, but now for 21 and 22, 100% deductible. And here's the information summary on the charitable contributions, $300 for an individual and couples at $600. So again, keep those in mind. So how does this change planning advice? And again, I realize there's a lot of information we've had to cover today, guys. But what I would tell you is much of it remains the same today. One thing, make sure that you take advantage of the PPP loan process. It's free money. Kind of crazy not to do that. If you need help, we can help you do that. We helped an awful lot of self-employed individuals do this with round one, and glad to do this in round two. Things that I've covered with the group in the past, and some of you will not have been here in the past. So I want to make sure to touch base on that as we go through. If you're self-employed, you ought to have an LLC. Now let me jump straight to the negatives because there are reasons why you guys haven't done this. If you have checked this out, it costs a little bit of money to put an LLC in place, but it's one-time money. In Kentucky, it's not a whole lot of dollars. We help individual self-employeds do this all the time, and you'll spend a little bit of money to do it. You definitely won't spend more than $500 even if you have somebody help you do it, if it's a firm like ours, including the fees that you have to pay to the Secretary of State and so forth. In addition to that, this will create a couple of fees that you do not have to pay if you don't have an LLC. And the cost annually to maintain your LLC is about $200. So there's a little bit of cost, both front end one time and on an annual recurring basis because you have an LLC. But what the LLC does when you have it in place throughout the year is that at the end of the year, if you've had a good year and it would save you taxes to change the format of your business, you can make that decision and you can make it retroactively for that year. So between now and really on into the summer, but let's say for practical purposes, between now and April 15th, when it's time to pay your taxes, you can decide that I want my LLC to be taxed differently than just as self-employed income on my individual return. And when you do that, typically the savings can be substantial. So all of the cost of doing this typically are outstripped by the savings, or we simply don't do it. So for $200 a year, you have a tool in your toolbox that could end up saving you thousands of dollars as you make more money selling real estate or flipping houses or investing or renting or doing the things that you do as a real estate professional. So make sure you have that in place. With regard to the other scenarios, the LLC doesn't hurt you in any way if you don't grow to the size where it's advantageous. So we do that analysis for a lot of companies and help them understand how their LLC should be taxed. And again, it's something to carry away from this, that you need an LLC in the big scheme of things to have that tool in place. I'd love to talk to you more about that on an individual basis, but again, I'm being respectful of your time today. The fourth item, had 2 clients that have gone through IRS audits this year, and in both cases, their lack of a good record-keeping system have cost them significant dollars in this audit. And there are lots of reasons for that, but suffice it to say that there are 2 things that happen when you don't have a good record-keeping system. One thing is you're not likely to capture all of your deductions as business professionals. What happens is that you'll simply forget about things, you'll fail to keep the receipt, you'll go back through your credit card statements and your checkbooks, and you'll miss something. This happens with mileage, this happens with expenses when you're eating out, this happens with the cost of the obvious things from time to time, like LAR dues and super keys and signage and MLS services, all the things that you guys know that you spend money on that helps you make money. But if you have good record-keeping systems like QuickBooks or Xero or Quicken, those really help you capture all of those things, because those systems can capture both your checking activity and your credit card activity. But that still leaves a couple of very obvious gaps, at least they're obvious in my opinion. Business mileage is something that I can't tell you how many people simply fail to accumulate. There is a tool out there that's put out by Microsoft called MileIQ. It's an app that's available both on both platforms. You can get it whether Android or Apple. And MileIQ for $60 a year tracks every trip you make in your car. And then it requires you to respond by saying, you swipe left if it's a personal trip, you swipe right if it's a business trip. And then it gives you a report that says your business deduction based on what's 56 cents a mile this year, your business deduction is X number of dollars in January, X number of dollars in February. It meets the criteria that the government requires. It shows a starting spot and an ending spot. The only thing you have to fill in is why was that a business trip? If it's to one of the properties that you're showing, pretty obvious. If it's to Walmart and you're picking up business supplies, you may have to make a note that says picking up business supplies. But the amount of work that you have to put in is minuscule as compared to keeping a manual log and manual records of what is my mileage. So MileIQ is a great app, would really strongly encourage you to use it. Again, if we had the luxury of excess time today, I would throw mine up on the screen and show you how it works. I love it. It has saved me much more than $60 worth of time annually, and will all day long profess that that's an excellent expenditure. Expensify is similar. Expensify allows you to take a picture of any business expense with your camera on your phone, and it automatically captures all the significant data off of there. You do virtually nothing. It puts it in an expense file for you. You took a picture of it, that's your indication that it's a business expense. It classifies it. It's able to read the vast majority of them and determine if it's a meal or whatever the expenditure is. There will be a handful. My experience has been 10%, 15%, that you may have to indicate what it was that you spent on that receipt. But it organizes them and puts them into something that's kind of like a glorified spreadsheet. So from that perspective, it's a tool that really helps the person that lives out of their car. And again, it's a low cost type of tool. It's not one that you'll spend a lot of money with. But the last point might be the most important. Find a planning focused tax advisor. When we're trained in school, we're trained to deal with what happened last year. We're trained to do audits of 2020. We're trained to prepare a tax return for 2020. We're trained to prepare financial statements and give summaries back to our business clients that reflect what has already happened. And the problem with that is, as small business owners, the most important, most valuable thing that you can get out of your financial professionals is advice about what to do tomorrow. Certainly the past is important, but it's important for compliance reasons. The advice about what to do tomorrow is what makes you more money. Keeps your taxes down by planning, looking forward, helps you structure your business in such a way that you can maximize your profitability. So all of these types of things are what you really want from a financial professional. Future predictions. Well, for the first time in a while, it's been 12 years, I guess, since we had a Democratic presidency, a Democratic House, and a Democratic Senate. And there are some trends that always happens, but when all of those line up, what you end up with are some emphasis in Congress that are pretty important. My predictions that I'm going to make are based on what Biden's campaign ran as a tax platform as they went. One thing that has been said repeatedly is that taxes are too low. Now, they've all been on record, both Kamala Harris and Joe Biden, saying we're not going to raise taxes on anyone under $400,000, but we're going to raise taxes on everyone over $400,000. The problem with that is this folks that have incomes over $400,000 that often are buying the homes that create commissions for you guys, or they're running the businesses that employ people that create customers for real estate activity. So there will be an economic trickle down. The predictions I've seen early on say that we'll see a shrinkage in the GNP of roughly 2% per year over a 4-year period based on some of these tax situations. The other things, though, is there's some very specific things that are being targeted. Right now, as real estate professionals, you only pay taxes on 80% of your profits. That's considered to be an unfair advantage that a business owner has that you shouldn't have based on the mindset that's being afforded in the tax platforms that have been proposed so far. Going down this path very far is not fruitful because with COVID out there, with stimulus going to soak up a lot of the original types of situations, any speculation is just that, speculation. But one of the bigger pieces that very well could have significant impact in your all's world is that there is a thought process that says that we're going to do away with two things on estate transfers. One of those is stepped up basis, which means that where right now most people do not pay estate taxes, even people with houses and 401ks and those types of things, depending on where the limit is set, very likely will have to pay estate taxes when they die. And why does that matter to you? The second plank of that is that without a stepped up basis, which is being proposed that we do away with that, there will be forced sale of a lot of property at the time frame when someone dies. This used to be in place when I was a really young professional, and the cases that were always mentioned were Billy and Susie had to sell the family farm because when mom and dad died, the estate taxes were so significant that they couldn't keep the farm. They had to sell it to pay the tax. And that's exactly what's being proposed, is going back to that over 30 year ago law that will require the sale and taxes paid on a lot of properties that are out there with low basis on the front end. So that's going to affect you guys. It's hard to know what the effect will be right now, but I think you need to understand that small businesses certainly will be a target. Additional stimulus, what will happen to the economy because of this, and we're going to have an economic pullback, but nothing's going to change for a few months or year, simply because it'll take Congress that long to get their feet under them with the continued management of COVID that's going on right now. So But for any of you that would like to stay on, I would certainly welcome questions. I'd welcome any information along that line, and just let me know what you've got. And thank you so much for being here and participating today.
Well, Rick, we really appreciate your time, your expertise. I think that certainly in this year, with all the tax shifts, it was a year that there would be maybe a little bit more engagement than some of your students of the past. Brett, your colleague, has kindly answered some questions throughout the chat. We'll certainly be cognizant of everyone's time. A couple quick questions here for you, Rick, that Brett wasn't able to attack or take care of in the chat. Regarding the PPP, someone had asked, could you assist in applying if they're not a client of yours? And then I guess on top of that, I'd say, like, what would you suggest for folks that didn't do PPP phase one and want to get in right now when the portals are opening?
Mm-hmm. Yeah, indeed they are, and the portals are actually opening for us tomorrow. There are some of the bigger banks that won't open until sometime next week. But the short answer is yes, we assisted a number of realtors, especially. We're very fortunate to represent a large brokerage in Southern Indiana and a large brokerage in Bowling Green. And because both of those brokerages have roughly 100 agents each. When PPP loans hit back in March, we were able to jump in with those groups and actually offer as a team that we would help anybody with their PPP loan applications. And so that's actually Brett's area of our firm. He's kind of the onboarding guy with regard to all of that. And anybody that's interested just simply needs to let him know that you're interested, and he would be more than glad to reach out and talk to you about specifics.
Perfect. And then Brett has listed his information in the chat if folks want to certainly reach out to him. In terms of tax prep, we were asked, what's the best way to file your taxes for a first-year realtor? If you don't have an LLC, married, filing jointly, I guess, obviously very micro-focused there, but for first-year realtors, what's some prep recommendations and things along those lines?
Yes, that's a great question. And I know we always have some new folks in this particular session. Basically, the bottom line is, without an LLC, you have some limitations on what you can and cannot do. So with those limitations in mind, basically, you're going to end up with a situation where that you will file extra pages in your tax return. Your question could mean two things: who should you get to do it, or it could also mean how will the structure be. So I'll kind of address both. The how will the structure be, you're talking about something called a Schedule C, which is a business summary that goes in your personal tax return. That business summary will give you an additional line item that ends up being carried to the front of your tax return. There are all kinds of credits and partial taxability and things like that are applied to it. It's not something you'd want to tackle with a pencil and a handful of tax forms. You certainly need to make sure this is done through a computerized system. I'm horribly biased, but 99 out of 100 times the money you would spend with a group like ours to help you do that is going to come back to you in form of tax benefit plus, simply because even a TurboTax, as thorough as TurboTax is, asking all the questions about expenses and telling you about all the categories, they can't educate you about what you don't know. So for example, they might say, what are your business miles? And you say, oh, I know I went to these properties this many times. Well, you also get business miles for trips that you made other places, picking up supplies, going to look at a property that never became yours, just all these other things. And so your intuitive knowledge about deductions frequently is going to be somewhat limited. How much office and home can I claim as a realtor? There are some deductions that are absolutely valuable in that line, and we would encourage those and show you how to structure them. So my point is, they're going to be, I tell everybody, 6 to 10 pages of additional forms that are going to be in your personal tax return. They're almost all filed electronically these days, so you don't understand the weight of the paper like you might have a few years ago. But it's significant additions to your overall tax filings, and will affect your taxes as well. In addition to income taxes, As a self-employed individual without an LLC in this format, you also pay your own Social Security and Medicare taxes. So there are multiple layers, and that makes these deductions very, very valuable. Whereas a normal tax bracket for you might be 12 or 22%, add another 15% onto that for your business income based on your Social Security and your Medicare tax levels. So finding $1 worth of deductions might save you 30 or 40 cents right off the bat. And that's not true for people who work for other employers. They don't have those multiple layers of taxes. So hopefully that helps you a little bit with your question.
Sure, appreciate that. And then I guess this maybe piggybacks on that a little bit. Could you provide some sources to someone interested in understanding tax breaks or self-teaching in order to get the most out of their taxes? Or I think even just certainly you could have a tax professional like yourself that they're working with, but someone trying to further educate themselves as opposed to a Google search or things of that nature. Anything that you'd recommend?
You know, I'll look and see what's out there recently. Basically, there has never been great resources that address industries. There just hasn't. And so from that standpoint, when I get this question, what happens is group like the National Association of Realtors, NAR, has out some resources and groups like that. But what you'll find out real quickly is that they often lead to more questions. And the reason's really simple. There, you know, look, if we were together in a room, I'd have you look around the room right now and see how different everybody looks. And one of the exercises that I would also have you go through is I would point out to you, you know, we would always ask people, how many years have you been in the business? And we get some feedback on that. And typically you find people that have been in the business for 3 weeks, and you find people who have been in for 3 decades. So based on that, the amount of knowledge that is out there with regard to particular situations is really limited because there's just too many differences. So one of the reasons we do what we do professionally is we engage with our clients. We pretty much insist on going through an education cycle with a small business owner, even a realtor that's self-employed, a couple times a year. And if they want to, more often, because we understand when you're a new business, you have this many needs. As you begin for education, as you begin to be in the industry for a while, your questions become more specific and the number of them drops off. And so it's just a really valuable process to put anybody through to get them educated about this. One of my favorite sayings, and I've got a zillion of them. One of them that I use all the time is, look, we can't come live with you. You wouldn't want us to do that. But if we educate you to at least know the triggers and the signals you need to be looking at, then you'll come back to us with more questions when you really need to have the answers.
Well, perfect. And I think all of our businesses are very, very different. And that's what makes, working with tax professionals like yourself certainly paramount in finding the deductions and getting us, and I think easing the intensity that comes with tax season for some of us and some of that anxiety. So if there's any other questions, we'll certainly try to tackle them maybe offline. I appreciate everyone attending. Rick, really appreciate your time. Everyone else, thank you for attending. And then certainly check out GLAR YPN. We have some upcoming events that'll be really exciting come up in the next couple months. And again, reach out to Rick. We'll get his information, and everybody have a good tax season and selling season here.